Stock Markets for Beginners, Part 8. And this is an extremely important part of this course. We're going to talk about financial ratios and how to calculate them. We're going to cover some very popular ratios, like what is a P to E ratio, what is a P to B ratio, what is a D to E ratio, what is the return on equity, what is the return on assets. We're going to talk about those, how you calculate them, why they're important, and we're going to give some examples on using these ratios on how to value a company. You need to know ratios if you're trying to be an investor to compare a company you're looking at to other companies and industries as a whole. This is a very important section, so let's go ahead and jump right in. Now that we have an understanding of financial statements, we need to talk about financial ratios. Financial ratios are an extremely useful tool when trying to analyze a stock, analyze a potential buy, because what this does, it allows you to compare a company to its competitors, compare a company to standard metrics of these ratios, and compare a company to industry averages. This helps you build a much better picture of the health and the value of a company. So we're going to cover a few popular ratios that are very useful to understand, and then we're going to show how you actually find the data to calculate those ratios within the financial statements that we just discussed. So, starting with the P to E ratio, the price to earnings ratio. This is the most popular financial ratio, and this tells us how much an investor needs to invest in a company in order to receive $1 in earnings. So if you have a P to E of 15, this means you need to spend $15 on stock in that company in order to earn $1 in earnings in 1 year with that company. If the P to E is 5, you only have to spend $5 in order to earn $1 in earnings. If the P to E is 100, if it's a high P to E, that means you have to spend $100 in order to earn $1 in earnings, and you get the picture. Some companies don't have a P to E, and this is because they are not profitable. So it's impossible to calculate because there's no earnings. A high P to E indicates that the market expects a company to grow in the future. So we see this with companies with a lot of hype around them or brand new companies who are barely profitable but have high expectations. A low P to E indicates the market may be undervaluing the company, or there's some kind of news that has come out where investors feel it should be worth less compared to either its competitors or the average P to E. So how do we calculate P to E? It's literally the stock price divided by the earnings per share. So if we go over to the computer, we're on Market Watch here, we're just taking a look at Tyson Foods. We can see that the stock price is $72.76 per share. So we're going to take that and then we're going to divide that by the earnings per share. In order to get that, we're going to go to the financial statement and then to the income statement. We scroll down to EPS, that's earnings per share. Take a look, it's $5.79. So we take that stock price divided by $5.79, and that gets you the P to E. In this case, it's about 12.5. Typically, a P to E of under 15 is considered a value investment. Next up, we have the current ratio. You can think of this as a company's ability to pay short-term debt obligations. That's debt obligations that are due within 1 year. So how well do current assets satisfy the current debts of a company? And that's how you calculate it. Current assets divided by current liabilities. And the ratio for this can vary pretty wildly based on industry, because some industries are just naturally much more asset heavy and liability heavy than other industries. For instance, the airline industry tends to have a ton of liabilities. So judging an airline to another company in an industry that has low liabilities can make you think the airline may be worth less. So it's important to always compare both with general guidelines and industry guidelines and competitors to see where a company lands as far as these ratios. So a current ratio of less than 1 is generally bad. That means that the company has a lot of liabilities compared to its assets. Now let's show how you find these numbers within the financial statements here. So we need current assets. In order to get current assets, we go to the balance sheet. We remember what the balance sheet does. We scroll down a little bit here to total current assets. We see it's $7.6 billion. And then we need total current liabilities. So we're going to scroll down here and look for total current liabilities. And we got 4.23 billion assets divided by liabilities. One thing to look out for, make sure you're actually looking at current liabilities, not total liabilities. Those are completely different numbers. Total liabilities, you can see that is much higher in this case. Next up is the P to B, the price to book ratio. This tells us how a market values a company compared to the value of its assets on the balance sheet. So the market capitalization of the company compared to if there was an asset sale, how much those assets could actually sell for. In order to calculate the price to book, you take the stock price and you divide it by the book value per share. Now this one's a little bit harder to calculate than the last two that we described, but it's still not too bad. So book value per share has a calculation in itself. In order to calculate that, you need stockholders' equity minus preferred stock. Now many companies don't have preferred stock, so in a lot of cases it's just going to be stockholders' equity, and then you'll divide that by shares outstanding, the total number of shares in the company. And a price to book of under 1 is generally considered a bargain. So first off, we need to find stockholders' equity. So in order to do that, we're going to go to the financial statements, go to the balance sheet, and we're going to scroll down here towards the bottom, and we look for total shareholders' equity. It's $15.25 billion. And then we need to find the preferred stock, and we can see the preferred stock is right here. This company does not have any preferred stock, so we just use shareholders' equity, $15.25 billion. And then we need to divide that by the total shares outstanding. In the case of MarketWatch, then you can just go to the company overview, and it'll tell you the total number of shares here, and that is 294.77 million outstanding shares. So it's just that equity divided by the total number of shares, and you got your ratio. Next up, we have the D to E ratio, or more commonly called the debt to equity ratio. This tells us the level at which a company is taking on debt relative to its net assets. So a high debt to equity ratio means the company is aggressively financing its growth with debt. It's taking on debt in order to grow as quickly as possible, which of course increases the risk in that investment. So the D to E is calculated by the total liabilities in the company divided by the total shareholders' equity. Maybe pause this and go on a financial statements and just see if you can find total liabilities in the balance sheet, and then come back to this video. Okay, you back? Also, a D to E of around 1 is generally considered good. However, this can vary again by industry, so you always want to compare, but over 2 is considered risky. Now let's show how we calculate this. So we need total liabilities. In order to do that, we're going to go to the balance sheet and then scroll down to liabilities and shareholder equity. And then we want total liabilities. Remember, not current liabilities in this case, total liabilities, that's $19.07 billion. And then we divide that by total shareholders' equity, which we can find right here, $15.25 billion. And there you go. Also, one important thing to point out with financial statements, we're going off of the year of 2020, but as of right now, there's actually 2 quarters that have come out with this company, their quarterly earnings. So that means the calculations that we're doing are based on 2020 numbers, which may not be the most up-to-date numbers. If you want the most up-to-date numbers, you're gonna have to go to the quarterly numbers, and in some cases, you will have to multiply quarterly numbers by 4, or depending on how many quarters you have, or go back quarters and add numbers in order to create a whole year, if you're trying to get the most recent ratio possible. Now, many sites will offer these ratios as well. You don't have to always calculate them yourself, but it's important to understand it, and sometimes it is hard to find these ratios, so understanding it makes your life a whole lot easier when you're really trying to dig into a company. Now we have return on equity. This tells us how good the management is at returning a profit on the equity available to them. How much profit can they make on their existing equity? In order to calculate this, we take the net income and divide that by the average shareholders' equity. And with this one, you want to be in line or higher than competitors. This is a very important one that you compare to competitors, and it's a very useful metric. So let's show how you actually find the numbers here. In order to find net income, you go to the income statement, you scroll down, and you'll see net income. We see $2.06 billion. Now we need the average shareholders' equity. So this is if you're looking for a specific period, a return on equity, you'll want the beginning number and the end number, add them together, divide by 2, get the average. But if you are just looking for a singular date, like the year of 2020, then you can just use shareholders' equity, which of course we know where that is at this point. We scroll down here, total shareholders' equity, $15.25 billion. Now the last ratio that we're going to cover is the return on assets ratio. It's important to note this isn't all the ratios. There are so many, it's basically unlimited, the number of ratios there are. These are just some of the top ratios. But now that you understand how to find the basics here, you'll be able to calculate other ratios on your own. So the return on assets ratio tells us how well a company can generate profits from its assets. This one is extremely important in my opinion. So the return on assets ratio is calculated by taking the net income divided by the total assets. Now over 5% is generally considered good, but again, you're going to compare this to competitors. Also, it's important to note that some industries naturally make more money with fewer assets and are worth more because of it. Now let's find how we can calculate this. We're going to go to the income statement, find net income. We know where that is already. Net income right here, 2.06 billion. And then we need to go to the balance sheet and find total assets. So it's net income divided by total assets. So we're just going to scroll down about midway here. And we see total assets, $34.46 billion. And there you go, your return on assets ratio. Now, I said the return on assets ratio is extremely important, and that's because some industries naturally make more money with fewer assets and are worth more because of it. A business that earns more money on fewer assets is going to be valued higher because it's easier to earn an extra dollar in profits. So I made this example to help highlight why this is true. So we're really breaking down this ratio. So we have two companies. We have Timothy's Trucking Company and we have Pamothy's Programming Company. So Timothy's Trucking Company has $100,000 in assets and $20,000 in net income, with a return on assets ratio of 0.02. Pamothy's Programming Company, she has very few assets. All she needs is a computer, a keyboard, general stuff, and she can do her programming. So she only has $10,000 in assets, but makes that same $20,000 in net income. That means her return on assets ratio is 10 times higher than Timothy's Trucking. Now, what does this mean? You can kind of picture this if we reverse the ratio, if we turn it into an asset to income ratio. If we look at it in terms of asset to income, $100,000 divided by 20,000 is 5. In this case, it's 0.5, 10,000 divided by 20,000. So what that means, in order to earn an additional dollar in profit, on average, there's some economies of scale, but in order to earn an additional dollar in profit with Timothy's Trucking Company, he has to spend $5. He has to spend $5 on assets in order to earn $1 in net income. With Pamothy's Programming, she only has to spend 50 cents on new assets in order to earn an additional $1 in net income. Now, of course, like I said, there's different economies of scale and that it doesn't always go in a linear fashion, but you get the picture. Naturally, the more profit you can earn on fewer assets, the more valuable the company is because it takes less money in order to earn more money. And there you have it, financial ratios. Give yourself a little pat on the back for making it this far, making it through part 8. The hard part is done. We just have a little bit more context to give in the next few sections, but we are getting there. In part 9, we're going to talk about how Warren Buffett picks his investments. We're going to show how to use a stock screener and how to determine if a company you're looking at has a competitive advantage. That way you have a higher likelihood of a long-term, high-yielding asset. How do you actually determine that? We're going to discuss that in part 9. So make sure you give part 8 a like. Make sure you subscribe to this channel. And if you want even more exclusive content, join the Patreon linked down below. And we'll see you over in part 9.